Hello and welcome to the Hindu's Business Explainer. I'm your host Kunal Shankar. It has dominated business news cycles for the past month now, but the story is far from over. The Reserve Bank of India recently barred Paytm Payments Bank from undertaking any routine activity, including accepting deposits or credit transactions or wallet top ups to pay monthly bills of FASTag. This has triggered concern across the fintech sector. But the central bank's January 31st directive came after what it called were persistent non compliances by the Payments Bank associate of 197 Communications and continued material supervisory concerns. So, what went wrong at one of India's poster children for furthering financial inclusivity? The bank's earliest regulatory troubles date as far back as 2018, even before OCL's much hyped IPO.
Five, four, three, two, one.
The payments bank was barred from opening new accounts and wallets. The reason? Compliance issues. That ban was, however, lifted in December of that year. In 2021, days before OCL's IPO, RBI fined the bank 1 crore rupees. This, the regulator said, was because the bank had, open quote, submitted information which did not reflect the factual position, end quote. And this happened just as Paytm was set to acquire a final certification of authorization for transferring OCL's bill payments unit to the payments bank. Then again, in October 2023, the bank was fined 5.39 crore rupees, this time for non-compliance on multiple fronts. First, flouting KYC norms. Second, delayed reporting of cybersecurity incidents. Third, breaching regulatory ceiling for end-of-day balance in certain customer accounts. But a directive from the RBI a year earlier, in March 2022, signaled what was to come 2 years later. In March of that year, the RBI asked Paytm Bank to stop onboarding new customers. The central bank observed certain material supervisory concerns and ordered Paytm Bank to carry out an independent audit. It was the audit's conclusion that led to the RBI's latest action. As is evident from the sequence of events, concerns about how Paytm's Payments Bank was being run had existed for some time and was likely one of the reasons why OCL was welcomed at a discount on the bourses on November 8, 2021. Other than its recurrent trysts with regulators, Paytm's corporate structure prompted concerns if it would at all be able to acquire the much needed Small Finance Bank's license. This license would have allowed the banking associate to carry out lending operations, which the Payments Bank license does not allow. In addition to this, equity analysts were also worried about the substantial proportion of board members based outside of India and the lack of clear-cut segregation between the bank and the listed entity. OCL's founder, Vijay Shekhar Sharma, owns 51% of the payments bank and OCL itself the remaining 49%. Here, it is important to note that RBI's guidelines bar the bank from providing credit-based products. A payments bank's primary purpose is to further financial inclusion. It is only to provide small savings accounts, help payment processes and remittances to low-income households and small businesses by enabling, quote, high-volume, low-value transactions in a secured, technology-driven environment. To understand RBI's concerns, the Hindu's Saptaparno Ghosh spoke to Indrajit Gupta, a veteran business journalist and the founder of the website Founding Fuel.
I mean, if one were to keep it simple, I think they're missing a very important gene, the gene to follow rules and to not kind of take the whole philosophy of, kind of move fast and break things to ridiculous levels. I mean, that's the startup culture that we know what it stands for, right? I mean, that's happened in the US, it's happened everywhere else in the world, and in India too, that startup entrepreneurs feel that they shouldn't be shackled by rules, right? In a regulated sector like banking, that is very difficult because it's not just about one startup and one NBFC. People have to follow minimum rules.
Safe to say, things went south at Paytm's banking arm because of ambitions that entailed lending. While Paytm Payments Bank did not lend directly, it provided third-party credit dispensing products, something which bothered the regulator because of the underlying credit exposure against the deposits. This is something payments banks were never envisioned to do. To understand this, we must understand the genesis of the entire payments bank concept. This was first envisioned by the Nachiket Moore Committee in its report examining comprehensive financial services for small businesses and low-income households. Payments banks were only required to provide a limited range of products, such as acceptance of demand deposits and remittances of funds, but they were expected to have a widespread network of access points, particularly in remote areas, either on their own or through a branch network or through business correspondence. In essence, they were to serve as an extension to the existing prepaid payments instruments or the PPI model. PPIs could only receive cash deposits from customers, store them in a digital wallet, and allow customers to pay for goods and services using the wallet. Here's Indrajit Gupta again on Paytm's journey.
There are three phases that you've got to understand. The first phase was really the launch of its wallet, right, which came much before Demon, right? And they did kind of use the opportunity to ramp up their customer base because none of the other banks really saw an opportunity to serve customers beyond their current market, right? If they already had, SBI had millions of deposit holders and all of that, they didn't see the point because, and ICICI, in fact, Chanda Kochar back then said very clearly that, look, we don't want to kind of support a wallet of our own because we don't see any opportunity for a business model around it. Why on earth should we waste money? People can keep the money in the savings account and use it as and when they needed it through NEFT or IMPS, right? So that was point one. So that gave Paytm an opportunity to use that time to really onboard customers who wanted to store money on the wallet. But they did that largely through hefty cashbacks, right? So a lot of college students and all of that who were attracted, who needed to, right? So we know that story. Fast forward to 2016, Demon, right? That was really the moment that was the Paytm moment, if you ask me. If there is a WhatsApp moment, that was the Paytm moment, right? Demon. And to give them credit, they saw the opportunity because people were struggling to access money in their accounts. And the fact that you could store money in a wallet and pay your bills digitally helped them expand. And in our story, we've talked about how Paytm used Demon to good effect. And you have to give the devil its due. They did that extremely well. They followed rules, right? At the same time, around that time, like you rightly said, they got the license for a payment bank as well, right? It was always a little unclear how a payment bank would really make money. And it took some time for them to get the license to actually launch the Paytm Payment Bank. I think it happened, if I'm not mistaken, sometime 17, 18, right? Because RBI, I think, wanted some things to be adhered to, right? Now, you've got to remember that a bank account is seen as a very trusted format or a vehicle, if you like, right? That commands a lot of trust. It becomes a lot easier for you to onboard customers because you own a bank license. Now, you're absolutely right. The traditional bank license and a payment bank license, there are differences. But for people who are not part of the banking system, Paytm offered them an opportunity to join the banking system.
Further, the Nachiket More Committee also noted the need to adhere to KYC norms because non-compliance on KYC norms leaves scope for large-scale online fraud. The committee also proposed that potential candidates for the payments bank license could include separately capitalized subsidiaries of non-banking financial corporations, existing corporate banking correspondents, mobile phone companies, consumer goods companies, the post office system, and real sector cooperatives. Again, any credit exposure was not allowed. Indrajit Gupta explains why Payments Bank was integral to Paytm's growth plans.
The original investment thesis was that of a super app, right? They had created an app which combined the wallet, it combined the payment bank. They offered a bundle of services to their customers, right? You and me and many others. You could do book tickets, you could do e-commerce and buy products there. You could do pay for FASTag, mobile recharge, DTH, electricity bills, you name it, right? Now, the whole idea was that you create this whole flywheel effect, right? Where you cross-sell a lot of these products because you have an installed customer base, right? And it's massive. It's a massive customer base. And you acquired those customers through both the Paytm payment bank route and the wallet, right?
Right.
So that was the investment thesis, that if you were able to orchestrate this integrated suite of services, people would transact, not just customers like you and me, but also merchants.
But was that all that payments banks were intended to do? The answer is no. While fintech as a sector has evolved in multiple phases, the idea of specialized entities carrying out specific functions only and focusing on resource optimization was being contemplated as far back as August of 2013. In a discussion paper on the way forward for the banking sector, the RBI had noted differentiated licensing could enable unlocking potential of these opportunities as it encourages niche banking by facilitating specialization, thereby reducing potential non-optimal use of resources. It felt that entities adhering to their niches would bear the potential to be individually large to sustain significant balance sheets, and specialized entities can play a major role in all of them. The important word to note here is niche, something that has often been repeated alongside financial inclusion, until the operating guidelines were finalized for payments banks in 2016. Unfortunately, Paytm Payments Bank, while one of the early movers in the payments banking space, has ended up as an example of what can go wrong if such an entity fails to adhere to the regulatory norms. On March 1st, the Financial Intelligence Unit of the Ministry of Finance slapped a penalty of 5.49 crore rupees on the payments bank. Their investigation concluded that a few entities and their network of businesses had engaged in a number of illegal acts, including organizing and facilitating online gambling. The unit explained that the money generated from the illegal operations, that is, the proceeds of crime, were routed and channeled through bank accounts maintained by these entities with the payments bank. These charges further muddy the waters for Paytm Payments Bank, which OCL has been keen to try and salvage through a possible sale to a potential buyer. Meanwhile, at a recent meeting to allay fears of the fintech sector, Finance Minister Nirmala Sitharaman suggested regular check-ins with the regulators. She also suggested that regulators, including the RBI, enhance the frequency of engagement with the sector to ensure stakeholders' concerns are heard. Thank you for watching. For more such explainers and videos, please subscribe to The Hindu. We're available on all your favorite platforms.